Good morning, everybody. This is Billy Trouch with the Tennessee Department of Revenue's Taxpayer Services Division. And on behalf of our Commissioner, David Geragino, and our staff in Taxpayer Services and the department, we welcome you to today's presentation on franchise and excise tax, kind of a little update on some existing laws that are out there for your consideration as we're in our tax filing season for the 2023 tax period. So with me, I've got Ms. Katie Julian from our taxpayer education section. And we have our fabulous expert of the day, Mr. Stephen Ferraro from our tax policy office. And we're very glad to have him. And joining us online is Assistant Director from Taxpayer Services, Dan Vinson, who will be assisting us electronically and otherwise. So how about that? So we have some information that I think you'll find very interesting today. Katie's going to walk you through some of the logistics here before we get going, and then we'll be offering you an opportunity to ask some questions at the end as well. So with that, one other thing I'll tell you is I'm going to put a copy of the PDF of this presentation, a link to it in the chat section here in just a moment, and you'll be able to link over to that if you don't already have it, okay? So with that, I'll turn it over to Katie. Katie, thank you very much.
Cool. Thank you, Billy. I'm so excited to have Stephen Ferraro as our subject matter expert today. I'm kind of fangirling over here. Just in case you don't know, when I gather all the information for these webinars, I pull all the info that you hear in our webinars from our educational resources, like our manuals, our important notices, revenue help. Stephen, I learned, was instrumental in drafting all of the educational guidance about this topic. So we are going to be hearing from someone who is probably the most knowledgeable that there is on this topic. Real excited to have you, Stephen. Like Billy said, we've got a few items here just before we get going. If you experience any audio or technical issues, we have found that one of the best ways to solve that is just to leave and then re-enter the event. Hopefully that won't happen to you. There will be a recording of today's presentation on our website either later today or tomorrow in our webinar video library. On that page, which is tn.gov/revenue, then you click on taxpayer education and tax webinars. That's where you can also find the PDF that Billy is linking to. That's just the way you get to it, the way you route over to that. And again, later today or tomorrow, we'll have this in the webinar video library. We're going to be closing chat down during the slides, and then we'll open it up towards the about halfway through this webinar for you to ask your questions. But if you have questions that do not get answered or that are on a different tax type or a different topic, our email here, revenue.support@tn.gov, is a great way to reach out to us and get an answer. You can also call our general tax line, which is 615-253-0600. We have a special line for F&E tax practitioners. That's 615-253-0700. We'll go over all that later again too. So, all right, that takes care of some of the little stuff. But like Billy said, we are going to be discussing a pretty specific topic today, which is recent changes in franchise and excise tax law. The Tennessee Works Tax Act resulted in approximately $400 million in tax cuts. We love to hear that, right? This was Public Chapter 377 that was signed into law last May of 2023. The goals of the Tennessee Works Tax Act were first to increase Tennessee's national economic competitiveness. I think cutting $400 million in tax cuts might do that, right? Second, to provide tax relief to Tennessee businesses. And third, to provide tax relief to Tennessee families. The main taxes that were affected were business tax, sales tax, and of course, franchise and excise tax. Numerous changes were made to F&E taxes. F&E taxes are imposed on corporations, including S corporations, limited partnerships, and limited liability companies taxed as partnerships for federal purposes. So if that affects you, then listen on here. Today, we are going to discuss the laws that are affecting the fiscal year in 12/31/23 with regards to franchise and excise tax. The topics are carry forward extension, bonus depreciation deductions, paid family leave credit, and single sales factor apportionment. There were a couple of other items that were worked into the Tennessee Works Tax Act with regards to franchise excise tax, but that don't go into effect until the 2024 fiscal year, so this current fiscal year, as well as some other stuff that's going through the General Assembly right now. We'll go over that briefly, but also share some of our resources with you as we go along today. So the first provision we're going to talk about is the carry forward extension. Another goal of the Tennessee Works Tax Act is to ensure future economic growth. One way this was done was by extending the carry forward period for franchise and excise tax credits to 25 years, which is an increase from the previous period of 15 years. You can see here this bullet list is which types of credits that this carry forward extension applies to. That's going to be industrial machinery credits, brownfield property credits, standard job tax credits for hiring persons with disabilities, community resurgence job tax credits, community investment tax credits, and qualified production credits. So the carry forward extension is going to apply to tax credits that are earned in tax years ending on or after December 31st, 2008. And it does apply automatically. Tax credits earned before this date do not qualify for the 25-year credit carry forward period. Hey, Stephen.
Yeah, hey Katie. I just wanted to chime in really quickly and say that just a quick note that when you're looking at this in TINTAP, although the net operating loss carryovers are coupled in with the other tax credits, I just wanted to note that NOL carryovers actually were not included in that 25-year carry forward extension. So all of the NOLs still stay on the standard 15-year carryover.
Gotcha. Thank you for pointing that out, because what you're seeing here, what he's referring to, excuse me. This is a snip in TINTAP of how you can see your carry forward credits. The example that I used is actually not a great one because, like he said, the NOL carryovers are not going to be carryovers that are affected by this extension. But if you have any of these credits, they would be there too. But this is actually how you would access seeing your credits in TINTAP. Logging into TINTAP, then selecting additional actions next to your F&E account, and then review tax credits tab. That's this tab right here. In case you weren't aware that you could view those credits on TINTAP, that is how you do it. So again, we will be implementing this new credit carry forward automatically. You do not need to contact us to apply the new credit carry forward periods. And side note, this change does not affect tax credits that have already been used to offset a franchise and excise tax liability. All right, and there you see how to know if you've got tax credits. So the carry forward extension resources here, we've got an important notice. It's important notice 23-06. The F&E tax manual, several chapters within our tax manual are going to deal with this. We got chapter 16, the job tax credits, chapter 18, community investment tax credits, and all other tax credits are going to be in chapter 15. And of course, a link to public chapter 377 here. Hey, Billy, you have something to add on this?
I just have one comment to make. Stephen Ferraro is online, and he and his bunch in the tax policy office need to be commended for excellent, excellent work on these
Yes.
manuals and the work that they do with notices and the other things that they help our department with. I don't know how many of you on this webinar have checked out any of our manuals, but I strongly encourage you to do it. They are absolutely phenomenal, and Stephen and his crew deserve much, much credit, and that's all I wanted to say.
I agree with you, Billy. The manuals really, when I first started with taxpayer services and went through training, we had tax guides back then, and they were great. Well, they were mediocre compared to what we have now. The manuals, which are fantastic, great examples, links to charts, lots of information to help you understand all of our tax types. And if we've got some time later, I'll take you over and show you where all the tax manuals are. But here, if you've got the PDF, obviously you can't link over on a WebEx screen to these hyperlinks, but if you have the PDF of this presentation, then you can click on the links there. And again, for anybody just now joining us, to get to a PDF of today's presentation, you go to tn.gov/revenue, click on taxpayer education, then tax webinars, and you'll see a little link over to class materials for today's webinar. All right, moving along to the next item here, bonus depreciation deductions. So for assets purchased on or after January 1st, 2023, Tennessee will now conform to the federal bonus depreciation provisions in the Tax Cuts and Jobs Act of 2017, the TCJA. All my words are getting mixed up right now. So bonus depreciation is an accelerated method of depreciation that allows businesses to immediately deduct a percentage of the costs of eligible assets in the same year that those assets are placed into service. Taxpayers can take bonus depreciation deductions for assets purchased on or after January 1, 2023 for Tennessee excise tax purposes in the year of the purchase that the taxpayer takes bonus depreciation on the asset for federal tax purchases. For assets, however, purchased on or before December 31, 2022, bonus depreciation deductions continue to be disallowed. So Tennessee actually had previously decoupled from Internal Revenue Code Section 168K, also known as bonus depreciation. And then the federal government extended bonus depreciation in 2017 with its passage of the TCJA. However, the TCJA phases out bonus depreciation over a 5-year period. And you can see here the phase out is as follows. It goes from 80% down to 60%. Hey, Stephen, you got something to add to this?
Yeah, I was just going to chime in and say that, as Katie was saying, this was a huge change for the excise tax because Tennessee pretty much since the inception of bonus depreciation at the federal level, Tennessee had always been decoupled. And so it was just for this most recent tax year that we coupled. And specifically, we coupled to the TCJA version of bonus depreciation. And that's notable for a few reasons, mainly this phase down schedule. So that's one thing I wanted to note is that the goal was conformity and to make things easier to have, us conform to the federal bonus depreciation provisions as enacted in the TCJA. With that said, that's where we're locked in right now. So that's important to note that the goal is that when you're filling out the return and you have Schedule J that as Katie said, for assets that were placed into service prior to 2023, on which bonus depreciation was taken at the federal level, those deductions continue to be disallowed and adjustments required on Schedule J. Of course, with conformity going forward, the idea would be that no adjustment would be required on assets on which bonus was taken, purchased in 2023 going forward. With that said, if Congress comes in at the federal level and makes subsequent changes to bonus, Tennessee is still locked into this phase down schedule. So once again, the goal being conformity, given what happens at the federal level, if changes happen, Tennessee is still locked into this phase down schedule and would have to, enact subsequent legislation to make any further conformity adjustments at the federal level.
Great. Thank you for pointing that out. So big changes might come to this that we're not going to, so we may end up decoupled again, basically, if the federal government changes this. So right now, this phase out is, as you can see it here, I won't go through each of those, but basically it's about 20% per year for assets acquired between January, within a calendar year, all the way through January 2027. As Stephen mentioned, this is going to affect Schedule J, and we have an example to go over with you here on the next slide. So What is commonly called bonus depreciation, by the way, is also referred to as special depreciation when it comes to the federal forms and instructions. So the bonus or special depreciation deduction is reported on Federal Form 4562, Part 2, line 14, and Part 5, line 25. So when the first year bonus depreciation is applied, the federal basis of the property is then reduced by this extra first year bonus depreciation allowance, and the remaining adjusted basis is depreciated from year 1 through the life of the asset under what's called the Modified Accelerated Cost Recovery System, or MACRS, federal depreciation provisions. So let's look at this example here. So on May 1st, 2023, taxpayer subject to Tennessee excise tax purchases a piece of equipment for its business that costs $100,000. That's for easy math here. This property has a maker's recovery period of 7 years for federal income tax purposes. So the taxpayer is going to elect to take bonus depreciation on this property, and their bonus depreciation deduction equals $80,000, or $100,000 times 80%. Again, going back just one page here, we're looking at when it was purchased. This asset was purchased within this year, so we're looking at 80%. The taxpayer must depreciate the remaining 20% basis in the property over 7 years using the applicable federal makers provisions. So in this case, the taxpayer's first year maker's depreciation deduction is $2,858, which is $20,000 times 14.29%. The taxpayer's total depreciation deduction for both federal and Tennessee excise tax purposes is going to be $82,858 for the 2023 tax year. No adjustments are required for this deduction on the Tennessee return because the state conforms to the federal deduction for the 2023 tax year. So you can see here the F&E manual is going to have a lot more examples and information on this topic that we don't really have the time to go into today. Information on topics such as the timing difference between the state and federal reporting depreciation adjustment on Schedule J, common depreciation adjustment reporting methods, depreciation schedules generated by computer software, and audit procedures. That's a really one of my favorite parts about our manuals is you can see audit procedures in the actual tax manuals that are there for the general public. So great information for you there. So some resources regarding this, we've got an important notice 23-07, Chapter 11, which is the excise tax section of our F&E manual, and again, a link to the public chapter that created all of this. All right, the third topic we're going to discuss today is the paid family leave credit. For the next 2 years, companies offering paid family leave may be eligible for a tax credit against their franchise and excise tax liability. So eligible companies can receive a credit based on the amount of wages reimbursed to their employees. So a temporary tax credit, again, it's just for the next 2 years, is allowed against the taxpayer's combined F&E tax liability based on the federal paid family and medical leave credit that's under Section 45S of the IRC. This is effective for tax years ending on or after December 31st, 2023, but before December 31st, 2025. It may be used to offset up to 50% of the combined F&E liability before the credit is taken, and any unused credit may be carried forward for 25 years now, per that first topic we discussed. So specifically, the Tennessee credit is equal to the federal credit taken under Section 45S of the IRC, but only with respects to the compensation that's paid to qualifying employees that are in Tennessee during the tax period. So if the business is located in Tennessee, but employees are located outside of Tennessee, that's something to take into consideration here. Hey, Stephen, you got something to add on this one?
Hey, yeah, just a few things here. So,
Great.
as Katie said, basically our intent here is that we are sort of piggybacking on the federal paid family leave credit. And so when you look at the form for this particular credit that we've developed, basically there's two things that we're asking. The first thing is, did the taxpayer take the federal credit? And so you'll list the full amount of the federal credit that was taken on the federal return. And then on the second line, we have a line for the amount of the Tennessee credit, which is once again equal to the federal credit, but only for amounts of FMLA pay that are paid to Tennessee employees. And so in the Tennessee Works Tax Act, it makes reference to Tennessee employees being employees whose payroll would be sourced to Tennessee for payroll factor purposes. That doesn't mean that the taxpayer has to be apportioning on Schedule N to claim this credit. That's just sort of the way that we establish who a Tennessee employee is. But the payroll factor rules, they pretty much closely align with the rules for Tennessee unemployment tax purposes. So kind of a good starting point to determine who is a
Right.
Tennessee employee, especially if you're a taxpayer that is, physically located outside of the state, but still has an F&E filing requirement. If you have employees that are assigned to Tennessee for Tennessee unemployment tax purposes, those would most likely be, Tennessee employees that are eligible for you to take this credit.
Thank you. That's very helpful. It's nice to hear too what this looks like when you actually go in to file. Like you said, it's going to ask you those questions to figure out how to use the credit. Some other information we've got here: eligible employers that qualify for this credit receive a credit in an amount equal to the applicable percentage of wages paid to these qualifying employees during any period in which such employees are on family and medical leave. So the credit equals the percentage of wages paid to qualifying employees while on FM leave. You see that at the first bullet. The base credit is 12.5% of wages paid. To qualify for the 12.5% credit, the employer must pay the employee at least 50% of the employee's regular wages. Can be more, but at least 50%. The credit amount increases in 0.25% increments until reaching a maximum credit of 25% of the wages paid when the employer pays 100% of the employee's regular wages. The maximum amount of paid leave per employee per year for which a credit is allowed is 12 weeks. Taxpayers calculate the Tennessee credit by completing Schedule PL. The credit is ultimately claimed on Form FAE 170, Schedule D, line 9, and then line 8 on Form FAE 174. If requested, taxpayers should be able to provide a schedule with the names of the Tennessee employees and credit amount attributable to each employee. So as with all taxes, keep maintaining and keeping really good records on this is going to be critical. So we've got an example to show you here. Company ABC is a taxpayer that is subject to franchise excise in Tennessee. ABC employs individuals who perform their work entirely inside of Tennessee. So that makes that part of the calculation pretty easy. So thus, the employee's compensation would be assigned to this state for apportionment purposes. ABC meets the federal requirements to be eligible for the federal credit. We're going to go over here in a slide or two about meeting that federal requirement. But during 2023, one of ABC's employees submitted a request to ABC for paid family and medical leave pursuant to their written policy. That's another part of the federal requirements, is having a written policy. ABC approves the request and provides the employee with 3 weeks of paid leave at 75% of their normal wage, which is $1,000 a week or $25 an hour at 40 hours. Let's see. ABC claims the federal credit for the paid leave provided to the employee and will be eligible to claim the Tennessee credit for the paid leave because the employee is in Tennessee, right? So ABC claims the Tennessee paid family and leave credit against its franchise and excise tax liability. The base credit percentage is 12.5, remember, But ABC is going to be eligible for a greater credit percentage because it paid more than 50%, the employee more than 50% of their wage, right? 75%. So therefore, ABC's credit percentage is 18.75. The employee's normal wage rate is 25 an hour, and he works, like I said, an average of 40 a week. So therefore, at 75% of his normal wage for 3 weeks, their paid family and medical leave for the year equals $2,250. Applying ABC's credit percentage of 18.75%, the F&E tax credit is going to equal $422. Pretty straightforward, I believe. So some resources for you here. We've got Important Notice 23-10, Chapter 15 of the F&E Tax Manual. Then I have a link here to IRS's webpage that has FAQs about family medical leave, such as who may claim the employer credit for paid family medical leave, who is a qualifying employee, what is family medical leave, how is the paid family medical leave credit calculated, so on and so forth. Lots more information on the IRS's webpage and a link to it there for you. All right, we got one more topic to discuss, and it's a big one, the single sales factor apportionment. Perhaps many would say that this is the most significant change that was enacted by the Tennessee Works Tax Act, and it's a phased-in adoption of a standard single sales factor, or SFF, apportionment formula. This adoption follows a trend among more than 30 states, I believe it's 32 states now, to apportion income using the SSF method for corporate income tax purposes. So most Tennessee taxpayers have previously apportioned net earnings or losses for excise tax purposes and net worth for franchise tax purposes using a traditional ratio that is based on 3 factors: property, payroll, and sales, which with a triple weighted sales factor. A single sales factor formula bases taxes solely on a company's sales within this state. So you can see here the SSF, I'm sorry, I said that wrong, I just realized I got a typo. That should say SSF. Oops, we didn't catch that, y'all. SSF. The SSF will be phased in over 3 years by increasing the weighting of the sales factor. You can see on this graph here for tax years ending on or after December 31st, 2023, but before December 31st, 24, the sales factor of the standard 3-factor apportionment formula will be weighted 5 times, and the total of the property, payroll, and sales factors will be divided by 7. For tax years ending on or after December 31st, 2024, but before December 31st, 25, the sales factor of the standard 3-factor apportionment formula will be weighted at 11 times, and the total of the property, payroll, and sales factors will be divided by 13. For tax years finally ending on or after December 31st, 2025, the standard apportionment formula will consist of sales factor only. There are some exceptions, and we will take a look at that here on the next slide. Excuse me. So manufacturers have had this single sales factor option for several years. Manufacturers that are already electing to apportion using a single sales factor will continue to use that formula and the entire time and not worry with this phase in. So they'll just keep doing what they're doing. That's for manufacturers who've already elected to apportion this way. Excuse me. Manufacturers will use the standard apportionment schedule N unless they have made the single sales factor election, in which case they'll use schedule S to calculate their franchise and excise tax apportionment ratio. The single sales factor election applies only to manufacturers making the election. It does not apply to the entire affiliated group. So a mixed affiliated group problem can arise when an affiliated group includes both financial institutions and non-financial institutions. There's lots more information in our manual about that. You can see here common carriers and air carriers are also an exception to this phase-in. They'll continue to use two-factor apportionment formulas involving revenue and miles factors. Hey, Stephen, this one's kind of confusing for me. I hope you can shed some light on it for us.
Yeah, no, you're doing great. I just wanted to add to what you've already said. Yeah, so like Katie said, for the transition to single sales factor, which is probably perhaps the biggest component of the Tennessee Works Tax Act, across the board, pretty much the vast majority of taxpayers who apportion on Schedule N will be transitioning to the single sales factor, based on this phased in approach that's noted on the previous slide. So these are our exceptions, and it's pretty much just because these taxpayers are taxpayers who typically don't use Schedule N because they have their own special industry-specific apportionment formulas that they compute on other schedules besides Schedule N. So yeah, as Katie said, manufacturers who have not elected single sales factor, which just as an FYI, manufacturers who are eligible to make the single sales factor election who have not already done so, they can actually still do that before the 2025 tax year when single sales factor election for manufacturers ends, because at that point it'll be single sales factor will be the norm. So manufacturers who have not already made the election, they'll still complete Schedule N, as Katie said, and we'll have this, phased in approach, including the property and payroll factors until 2025. But if there's a manufacturer who has not already made that election and wishes to do so, they can go ahead and do that. And then they'll complete Schedule S and can go ahead and start using single sales factor. The rest of these taxpayers on this slide, these are taxpayers who will not transition to single sales factor. REITs are there's a bit of a caveat with REITs because they actually will transition to single sales factor for franchise tax purposes, but not excise tax purposes. But the rest of those taxpayers, common carriers, financial institutions, and telecom taxpayers, telecom will actually continue to use the standard property payroll sales, triple weighted sales apportionment formula. And then FIs and common carriers have their own special industry specific formulas that they'll continue to use. And then I don't know if we got to this yet, but yeah, as noted at the bottom, there is actually an election for certain taxpayers who wish to continue using the current property payroll triple weighted sales apportionment formula. If for some reason they would like to continue doing that, they can make an annual election. As noted, in order to do that, it would have to result in a higher apportionment ratio than if they applied single sales factor, and they would have to have net earnings for that particular tax year as opposed to a net loss. And sort of the main rationale behind why that was included in the bill was to allow certain taxpayers who had accumulated tax credits and who might be anticipating that they would have a lower tax liability under single sales factor. It was really just primarily to give them that option to continue using the higher apportionment formula so that they could continue to liquidate their earned tax credits in Tennessee.
That very helpful. Thank you for adding that in. Actually, on that note, what Stephen was talking about with the manufacturers, common carriers, FIs, telecommunication companies, and REITs, I'm going to take you over to a chart in our manual that breaks down how all of those institutions are handled. Let's see here. Web browser. You should see my web browser now. I've got our F&E tax manual open. Actually, I'm going to take you to the top. This will take this opportunity to show you how to get to this manual. I'm on tn.gov/revenue. You can get to all of our manuals by going to tax resources and clicking on tax guidance, and then clicking on tax manuals. I'm going to increase my page a little bit. Okay. I got something in my throat. Take another sip. So I'm going to click on our franchise and excise tax manual into the current one. I'm going to search. You can see this is a 621 page manual. Control F and search apportionment. If I spelled that right, I think it's, yep, apportionment reference charts on page 448. Currently, of course, if you're listening to the recording of this webinar, these page numbers change as we update it, but I'm going to click on this chart here. Basically, these are apportionment formulas that apply to various types of taxpayers. You see, we've got common carriers, financial institutions, and FI unitary groups, the captive REITs and their affiliate groups. Just going to slowly, I don't want to make y'all dizzy, but just to show you how this chart, if you're one of these taxpayers, this might be helpful for you. These are for tax years ending on or after December 31st, 24 through December 31st, 25, and so on and so forth. All right, so hopefully you'll find that helpful. And on that note, some other resources regarding the single sales factor apportionment and this huge change. Important notice 23-11, chapter 14 of the Franchise and Excise Tax Manual, and again, public chapter 377. So I told you at the beginning, we were just going to discuss the F&E changes from the Tennessee Works Tax Act that went into effect for the current return that we're filing. So for tax years ending December 31st, 2023, there's other changes that the Tennessee Works Tax Act actually enacted. The standard excise tax deduction for tax years ending on or after 12/31/24. There's an important notice there, important notice 2304, and for tax years ending on or after 12/31/24, also there is an exemption of $500,000 of business property from the franchise tax minimum measure. Important notice 2305 there, so something to keep in mind. And there's actually a bill going through the Tennessee General Assembly right now, House Bill 1893. If this bill passes in its current form, then the franchise excise return that is due April 15th for calendar year 2023 must be filed in accordance with the current law, which means Schedule G must be completed and tax paid on Schedule G if it's greater than net worth. There's a big change coming, though, which would mean going in and amending and then getting a refund. We're going to be talking about that next month's webinar. Originally, we had a different topic, but this is such big news. We decided to go ahead and mix things up and add this in as our webinar next month, which is going to be potential Schedule G franchise tax refunds. I think everybody expects this bill to pass. Most likely in its current form. I can't make any promises on that, but by the time we have our webinar next month, which is, I believe, April 30th, should have passed and been signed by then. But at any rate, we'll be discussing all of the implications of that. All right, so I'm going to go ahead and open up the chat. Billy, if you want to hop on in here and go over with them this stuff while I go in and do some editing to the chat here.
Yeah, sure, Katie. Thank you very much. And a good job going through some really technical material there. And Stephen, thank you for your input during the
Yes.
presentation too. Very helpful and very insightful too. So just looking at this slide here, this is different ways that you can contact the Department of Revenue through social media, email signups. Oh my goodness, we basically have everything. So if you're really interested in the Department of Revenue, we are interested in telling you about the Department of Revenue. And you see our email address there at revenue.support@tn.gov. that goes to most of the people that answer these questions are on my team, and I'm proud of them. They do a fantastic job every day. Notice the franchise and excise phone number on this slide here in bold. Katie put 615-253-0700. That is different, okay? That is only for franchise and excise taxes. It's a dedicated line for a very complicated tax. So our service is available from 8 to 4:30, basically, sometimes a little earlier, sometimes a little later, Monday through Friday, excluding holidays. So this upcoming Friday, as we record this, we are on a state holiday, so we will not be there Friday. And then our 0600, so 615-253-0600 is our regular call center, our call center that handles all of our other tax types. And you want to call when you're having questions about gaining access to TINTAP, or you've got sales tax questions or business tax questions or all the other stuff. So make sure to contact us when you need us. Okay. So Katie and Stephen, I'll let you guys discuss some things that have come up in chat there. Thanks.
Thanks, Billy. Lots of questions in chat about how can I see these slides? And I think Dan just posted another link over to a PDF of the slides. So that I think chat disappears if you got in late or left and came back in. So there you go. There it is again, a link to all the slides. I want to say too, before we get any further into these questions, just there is a question here. Someone says, please confirm that the $100 minimum franchise tax is not required for entities with business property of less than 500,000. We're not going to get into franchise excise tax basics too much during this webinar because we're really wanting to hone in and focus in on these recent law changes. But I do want to recommend to you a great webinar that we have that's on F&E basics. We shared some resources, our manual, which is great, but the F&E basics is that webinar gives you a really good overview of the franchise excise tax, including how the minimum tax works and all that. So, Stephen, are you seeing any classes? I mean, are any chats in here that are something we want to address?
I have one
Okay.
before Stephen goes. Somebody had mentioned if their LLC submits an F&E return, do they also have to pay the business tax return? Maybe. So there's been a big change in business tax law that we are really on fire about at the Department of Revenue, to be honest with you, with hundreds of people wanting to get information about that. But let's just say it this way, apples and oranges. Franchise and excise tax stands alone, business tax stands alone, sales tax stands alone. These are not interconnected. So when you reach out to our department, make sure you're very clearly talking about the type of tax that you're wanting assistance with. Of course, today's presentation being on franchise and excise tax. Thank you.
Thanks, Billy. You might have said this, but I was typing something to a attendee. We do have a webinar that we did on the business tax changes we had that webinar back in September, and then a couple months ago we had business tax basics. So if you're confused between business tax and franchise excise tax, that might be a good place to start as well. Let's see here. Stephen, are you seeing anything in the chat that you want to address?
Yeah, I was just scrolling through. Yeah, definitely several good questions in there. Like you said, I know some of these are related to other areas of F&E, not necessarily to what we have discussed today, but nevertheless, good questions. I was trying to scroll through and see there was anything that I could answer sort of off the cuff.
Stephen, would you mind answering this question? Someone asked, please confirm that the $100 minimum franchise tax is not required for entities with business property of less than $500,000.
Yeah, so that's a great question. So the five, just to get into that a little bit, the $500,000 threshold that you're talking about there, that is what's referred to in the law as the bright line threshold. And so basically, when you're looking at whether you're subject to F&E, in order for a taxable entity such as a corporation or an LLC to be subject to F&E, they have to both be doing business in Tennessee, which is a very broad, very broadly defined. Um, and so most of the time, that's really not the question. The question is also the entity also has to have what's referred to as a substantial nexus with the state. So they have to have both doing business and have a substantial nexus with the state in order to be subject to F&E. And so part of that within the substantial nexus part is the bright line test, looking at whether the entity has more than $500,000 worth of gross receipts that are attributable to the state during the course of the tax year. And so um, it's one of many tests that are looked at to determine whether the entity would be subject to F&E. So if an entity has less than $500,000 in gross receipts attributable to Tennessee during the tax year, that does tend to point towards the fact that the entity would not have a substantial nexus. It's not conclusive because there are other tests that you have to look at, but in general, if that were the only test that you were looking at and the only connection, if an entity determines that it does not have a substantial nexus, then generally it would not be subject to F&E. But in the F&E law, there also is this other provision that's sort of we talk about, the Schedule G minimum measure, that's been discussed right now in the legislature. But there's also a minimum, that's not to be confused with the minimum $100 F&E tax. So there's another standalone law that basically says that if you're an entity that is registered with the Tennessee Secretary of State to do business in the state, that really just by way of having that registration. So in other words, if you register to do business with the Tennessee Secretary of State and you did nothing else, there actually is a provision that says you're still liable for this $100 minimum franchise tax. And so it's a good question because I know that there are some questions about how that interplays with the doing business and substantial nexus standard, to say, well, if I'm not actually doing any business and I determine that I have, fall below the bright line gross receipts threshold, do I still owe this minimum tax? And traditionally, it's been the department's position, I believe, that, just if you're only registered and not doing anything more, that you're still liable for that tax. Because I believe that the problem is that if you, at some point go back to the Secretary of State, to either close that business if you haven't done anything, or just to get current and have to seek a tax clearance at some point down the road, we'll be looking at, well, whether you had to file those minimum $100 returns. And if you haven't, then that could potentially create issues down the road in trying to get a tax clearance or getting current with Secretary of State.
And Stephen, thank you. I think that all the information you said is quite important. What I'm sort of chuckling to myself about is, the person was probably looking for yes or no. And this is not your fault. It's not your fault. That's franchise and excise tax law. It is a bear. It really is. So the main thing I heard you say in there that I thought was really important for people that are just don't really have a real big base of knowledge about franchise and excise tax is when you're registered with the Secretary of State, it's more or less like a tag you're it with us. So you're going to be filing a franchise and excise return. You're going to be paying at least $100. we deal with a number of taxpayers at various levels, large LLCs, corporations, people like this that are very astute when it comes to the filing of their franchise and excise taxes. But the vast majority of people we deal with in our office are people who have very limited knowledge about F&E tax. So when they have that limited knowledge, we want you to reach out to us, to the phone number we've provided, to our website, to our manuals, to things like that, so that we can help you get the answer that you need. One thing I want to mention that Stephen had brought up is about the bright line, the 500,000 versus some other things too. There's a very detailed discussion of nexus or presence in the franchise and excise tax manual. So you want to go to that manual and look at that and see if you meet any of the registration requirements that are outlined there. It is not a black and white answer. And that's what we were looking for. I know it. I know, but you can't get that. It's not F&E tax. It's not the way it works. It's like I always joke about the 7 years ago sort of dissertation about things, and that's just the way it goes. But we can walk you through it. We want you to get to the right answer. We don't want you to not know, but we want you to know everything you need to know. That sound weird? Okay. Anyway, that's what I wanted to tell you.
So, y'all, somebody put in the chat that the links in the PDF are not working, and you're right, they're not, and I don't know why. I did it the same way I always do it, but I just resaved it as a PDF, and the links do work, and I'm putting a request in right now to upload that. Press send on this. All right, so what that means is probably that couples with another question that I saw in here regarding when can we register for next month's webinar. All right, so when you go to, I'm going to go over there right now, web browser, taking you over to tn.gov/revenue, down to taxpayer education and outreach, clicking on tax webinars. So right now, this link is still the one that has where the hyperlinks are not working for some reason. Here in just maybe a couple of hours, maybe less, when you go to this page, you're going to see a new event registration here for next month's webinar for this House Bill 18, whatever it was. I don't have it in front of me. 1826. The new webinar is going to be ready to register for, but you can review the video of this one and the updated PDF that has working hyperlinks in it. Down here, you scroll down and there's a webinar video library. You can sort it by tax type or search a keyword in it, but that's where you'll find the video of this webinar as well as a PDF that has good links in it. Sorry about that. I'm not sure what happened.
Katie, can you take just a moment and walk them to the website so they can see where they can click on the PDF for the material?
Sure, I
Because
thought I was doing that. I didn't do that, did I? Was I not over there?
no, I think you were probably
I
still
was
on
talking
our
like I
little
thought I
screen here.
was.
Yeah.
I'm sorry.
Imagine you making a mistake. This is terrible.
Loaded with them today. Okay, so can you see my browser now?
Yes, we can see it now.
Okay,
Thank you.
I'm on tn.gov/revenue. I'm going to scroll down to taxpayer education and outreach, then click on tax webinars. And this is the area where I was saying you'll be able to register for next month's webinar here in just very soon. I've already put in the request to update the website with that. This participant guide is the one that has bad links in it, or links that don't work. What you'll do is scroll down here a little ways, our webinar video library. Later today, there'll be a video of this webinar and a PDF that is updated with working links, hyperlinks in it. Again, like I said, later today, maybe tomorrow. It just depends on how fast this video uploads to WebEx for me. I'll get it up here as soon as possible. So sorry about that. Not sure what happened, but we'll get it fixed for you. All right. Well, we're running low on time. Stephen, as I've been talking, has there been anything else that we want to address in the chat?
Yeah, I was looking back through and I have a few questions I found that I can pretty readily answer off the top. So there was a question about if credits that were generated in the 2007 tax year and credits generated in the 2008 tax year. So yes, credits that were generated in the 2007 tax year, that was the last year that had the 15-year carry forward. And so any of those credits that are not applied on this 2023 tax return filing would expire after the 15 years. And then the 2008, that's the first year that the 25-year carryover is in effect. So credits that would have otherwise expired after the 2023 filing that were generated in 2008 are now carried forward an additional 10 years. So the 15 plus 10 to get to the 25. And then there was also another question. Let me go back through, see if I can find it. And then there was another question about the sales factor. So yes, the sales factor, single sales factor apportionment applies to both the excise tax base and the franchise tax base. So on the excise tax side, when the taxpayer calculates net earnings, the single sales factor apportionment formula will be applied to that to determine the portion of those net earnings or loss that are apportioned to Tennessee. And then on the franchise tax side, the apportionment is applied to the net worth base. And of course, under current law, we still have the greater of Schedule F net worth or Schedule G property. So the apportionment applies to that net worth base on Schedule F. Let's see, there was one more that I was thinking that I saw that I wanted to try to answer. Okay, so yeah, there was a question about fiscal year ending June 30th, 2023. If these new laws apply to that return or if it's old law versus new law. So looking at that's one of those things where you have to kind of drill down a bit to look at some of these effective dates in the Tennessee Works Tax Act. Because there are various, effective dates that were kind of buried within that act. So certain provisions took effect certain times. For the most part, most of the F&E related provisions in the Tennessee Works Tax Act applied to tax years ending on or after December the 31st, 2023. So tax years ending before December the 31st, 2023, for those 2023 fiscal filers, these provisions would not yet take effect until the subsequent year return for those filers. So yeah, fiscal year filers for 2023 that are on extension, whose tax years end before December the 31st, 2023, for the most part, they're going to be on the old law. So prior to many of these changes taking effect.
That's a good question.
It is, because that's one of the things looking through, as you noted, we covered several of the provisions that are in effect now for the 2023 returns being filed this year. But then there are still several things that had various effective dates. So that is something that, we kind of had to look at as well, as far as implementation. And then there was another question about the federal paid family leave credit. If you don't take the federal credit, can you still take it for Tennessee? I'm leaning towards no, because I think the idea there is that, once again, that we're sort of piggybacking on the fact that the taxpayer has taken the federal credit, to also take the Tennessee credit. And so
I agree.
Yeah, so I
And like
think
you said, it asks you that question when you first open up that schedule, I believe, right?
Yes, exactly. Because when you look at the schedule PL that we've implemented for that credit, the first line, it asks, what is the total amount of credit that you've taken on the federal return? And then on the second line, you list the amount of that credit that is attributable to the FMLA compensation that you've paid to Tennessee employees. So I think the idea there is that, yes, that you've taken the federal credit And then if you have, then you're eligible to take the Tennessee credit.
I would agree with that. I would agree with our expert. Anything you say, I
And
agree with,
and
Stephen.
then and then another question, just really quick about I know we're at time, but the $100 minimum tax, are those subject to estimated payments? There are certain rules for that, but generally, if you're a taxpayer that is only paying the minimum $100 tax year after year, that wouldn't be subject to estimated payment rules, because estimated payments kick in if your liability for both the current and the prior year is greater than $5,000 in your total F&E tax liability. So yeah, that generally, yeah, you wouldn't be looking at that for the minimum $100 tax.
Right, right. Well, we have run out of time. We had a lot of great questions. If we didn't get to your question,
Yes.
again, right in front of you here, revenue.support@tn.gov. Send us an email, or if it's an F&E related question, you can call us at 615-253-0700. All other tax types, call us at 615-253-0600. Again, Stephen, can't thank you enough. It was great having your expertise on this. For a lot of these topics are pretty complex, and couldn't do it without you, and also the manuals and notices that you help draft. So much appreciated to you for joining us today. We do have, as I've mentioned, next month's webinar, a change. Originally, it was going to be the Retail Accountability Program. We're going to shift things and talk about the potential Schedule G franchise tax refunds. Again, that I mentioned is House Bill 1893. I got that wrong earlier. Potential Schedule G franchise tax refunds as a result of what we expect to be the passage of House Bill 1893. There's also a new business workshop. That's a 3-hour workshop that we host for new businesses, where we go over the big basic taxes, business tax, franchise excise tax, and sales tax, along with some other stuff, resources, how to navigate TINTAP. That's next week. You can register for that by going to, again, tn.gov/revenue, clicking on taxpayer education, and then clicking on new business workshops, and register for that there for the workshop next week. Saw a few questions in the chat about how to receive CPE credit for this. That's continuing professional credit for CPAs, accountants. When you leave this event, you will see a survey pop up, just a couple questions where you can put in any feedback for us. But one of those questions is, do you need CPE credit? Just answer yes to that, and then we'll get it right out to you. Anything else y'all want to add?
From me, thank you very much to Stephen and Katie also, as always. Great job, and thanks for everybody participating today. And we hope this was helpful to you.
I have a feeling we'll see you all at next month's webinar. If you're here for this one, you'll probably
Oh,
be
for
interested
sure.
next month, right?
Absolutely.
All right. Well, have a good one, and we'll see you soon.
Okay, thanks everyone.
Bye-bye.
Bye-bye.
Thanks.